Londra'dan herkese merhaba. Bu bölümde Türkiye'nin kredi notuna özel bir parantez açıyoruz ve Fitch Ratings'in kıdemli direktörü Erich Arispe Morales'le birlikteyiz. Hi Eric, thanks for joining our program.
Hi, Verfu, and good afternoon to all your audience.
First of all, as Fitch, you have revised Turkey's outlook to stable, affirming at BB minus, right? What are the key factors behind this revision, and why now, as we know that this is an out of the schedule announcement?
Indeed, I think it relates to also, let's say, unforeseen or unscheduled external events that have been had a significant impact on one of the major drivers of our positive outlook early in January, and that is the level of international reserves. So, as you well know, we have seen that over the first month of the conflict, there has been a significant decline in international reserves, both as a result of the CBRT interventions, but also declining gold prices. Now, the prospect that this conflict could have a much more permanent effect, regardless of the resolution and peace discussions that are ongoing right now. But the potential of the much more permanent effect of energy crisis, of course, creates downside risks to the inflation trajectory in terms of higher inflation, but also in terms of wider current account deficit. So those were the factors taken into account and are related mostly to the impact of the external shock on Turkey.
Mm-hmm. So your next scheduled review date is, as far as I know, 17th of July. So shall we expect a rating downgrade as the outlook is stable, or shall we first expect to see a negative outlook before a downgrade?
So we cannot prejudge, of course, the decision of future committees, but I think that at this point, the stable outlook signals a couple of key underlying assumptions from our part. First of all, that there is a strong commitment to the main tenets of the current economic program, which is most reflected in policy and monetary policy side that tries to maintain real positive rates and is focused on leading to a lower inflation, combined with income policies, fiscal policies that support also that endeavor. So I think in these times of heightened uncertainty, providing this guidance in terms of commitment to the past 3 years policy settings provides underpinning, in supporting, the current stable outlook. Also, what we've seen, as you know, since early April, and with the prospects of negotiations about an end to the conflict, there's been reduced pressure on international reserves. And actually, looking at the daily data of the central bank, there may be even like a recovery in the net position. So I think that currently, both the expectation of maintenance of conventional and credible policy settings, as well as the still relatively improved buffers, if you compare, let's say, to 2022 or 23, still support the current stable outlook on Turkey's rating.
Mm-hmm. Under current conditions. As far as I understand, the major driver behind this outlook changes the weakening current account deficit and reserves, as far as I understand from what you say. So how do you view Turkey's external financing needs right now in terms of current account deficit? Can you name us a few figures in terms of your forecasts? And are FX reserves, do you think, at comfortable levels in your view right now?
So on the current account deficit projections, we have increased those to about 2.5% of GDP for this year. I think this is still relatively low compared to previous episodes, external shock or, inconsistent policy mix that we have seen in Turkey in previous years. So I think that the pressures from the current account deficit currently remain manageable. Of course, if there's, as we said, the risk of a prolonged period of high energy prices, there could exert some pressure on energy prices. But of course, we would also expect that in that case, there will be some easing of the pressures on domestic demand that have also pushed some upward pressure to the current account deficit. As you know, the figure that was always cited, that is the short-term debt on a residual basis for Turkey, that's external debt repayments. There is about 239 billion as of the latest figures by the central bank. Of course, it looks massive, looks significantly higher than the level of reserves. But we also note, as one of the credit strengths for Turkey, is that the sovereign and also the private sector has had access to external financing even in periods of heightened policy or external uncertainty. So that's also a positive factor for assessment. Looking ahead, what we expect is that reserves will be broadly stable at the current level. That's at the beginning of April level, so around 164 for the end of the year. As I said, the daily figures published by the central bank show they're already probably, they have above that level already. But I guess what we highlight is that at the current level, they are compatible with the stable outlook. And also what is important, again, go back to the policy guidance and the expectation that policies will be still focused on maintaining improved macroeconomic stability prospects. And that's reflecting on a sustained decline in inflation.
And in terms of current monetary policy, shall we forget about interest rate cuts in Turkey? We know that CBRT raised the cost of funding by like 300 basis points. And we have another meeting on the 22nd of April. What do you expect?
I think, what we have seen in other central banks as well in emerging markets is around a bit of caution, right? I think that I cannot think of many central banks that have led to immediate tightening, right? As some consider this to be a supply shock and maybe temporary in nature. But we would expect central banks, including the Central Bank of Turkey, to have a conservative position in the near term. Now, how the policy is calibrated going forward, that remains subject to the duration and the actual impact of the shock. So I think that for us, we still expect rates to come down this year, but probably to a much more muted pace than what we were anticipating at the beginning of the year.
Mm-hmm. So what is your expectation there? How many more points under current conditions? There's a room for a rate cut in Turkey in the coming month?
So what we for next month, probably we do not expect rate cuts. As you said, the central bank has increased its effective cost of funding by, providing financing at the ceiling of the band. In terms of our projection for monetary policy rate for this year, we expect this to come to 32.5 in 2026 and continue easing to about 23% by 2027, by the end of the year.
By saying next month we don't expect a rate cut, you mean the 22nd of April meeting, right?
That's correct, the next meeting. Sorry, apologies.
Okay, in the next meeting you don't expect a rate cut. Do you think that there is a need for a rate hike in Turkey?
We don't, prescribe or encourage policy direction from any government or central bank, so I cannot comment directly on that. I would say that, of course, policymakers will have to evaluate to what extent, the measures already taken, both in terms of the FX market, but also the tightening of monetary conditions, are consistent with moving closer to their end-year inflation targets. But of course, that remains a challenge given the current inflation dynamic and the risk of a much more protracted energy shock.
Is inflation moving in line with Fitch's expectations, your expectations? And what about growth? What do you expect growth in Turkey this year?
Sure. So, we have upgraded our inflation expectations for this year in terms of end year. So now we're expecting 27% by end 2026. We were having slightly lower inflation in our January review. And I think that, that overall our view remains the same. We think that, that it remains a challenge for authorities to bring down inflation to levels closer to what we see for other that would be rated sovereigns. And that's, about between 3 and 5%. So I think that, that's still a policy challenge, and even with before the external shock. So I think that, is still looking at this year, there are upside risks to our forecast. But of course, there have been policy measures implemented that have, let's say, prevented a faster pass-through of energy prices to inflation. And those have been much more on the fiscal side.
Mm-hmm. When we are talking about your forecasts, are you assuming that oil prices will be around $100 or will be back to $70?
No, I think that still we are working on an assumption much closer to $70, assuming that that the peak of energy prices are for the second quarter of this year. Now, as I said, we are reviewing our scenario. There's still a high degree of uncertainty, but certainly, if our previous expectation that energy prices will start coming down in the second part of the year does not materialize, either because the conflict continues or because the disruption caused to production and transport capacities remain much more permanent, then certainly we'll have to upgrade our oil forecast, with of course the impact will be as well in current account and inflation projections, not only for Turkey but most emerging markets.
When do you think you will revise your forecast on oil prices? In the coming weeks or months?
It's an ongoing process. I cannot give you a date on that.
Okay, last question. If I ask you lastly, what is the cost of this Iran war to Turkish economy? What would you say in a nutshell?
I think what it's important to highlight, is that Turkey has implemented a consistent policy framework, broadly speaking, since 2023. So it just adds to the challenges, not only intrinsically in lowering inflation from very elevated level and rebuilding policy credibility, but also being impacted by shocks that are exogenous to the policy mix, right? And one of those was last year through a domestic political shock. There was also, the tariff shock to the global economy after Liberation Day. And now you have this geopolitical shock. So I think that, that it's a continued test of the authorities' commitment to a much more conventional and credible and consistent policy mix. But also it increases the challenge of actually achieving, the lower inflation that, of course, could support medium-term growth prospects and as well reduce Turkey's vulnerabilities.
Erich Arispe Morales, thanks for joining our program.
Thank you for giving us the opportunity to talk to you. Bye, Berfo.